Hi everyone, it's Marissa here and thanks for tuning in to another Rise High Live. Today I am joined, it's a very special episode, I'm joined by Peter Koulizos, who is also known as the property professor and who is the
Program
Director of the Master of Property at Adelaide University, but also he's been researching and investing in property for over 20 years. Would that be fair to say, Peter?
Yep.
He's known, well regarded throughout the country for his property expertise, and we're very lucky to have him on the show today. And today I'm planning to pick his brain about all things property and where to buy and what to buy, and we're also going to be talking about time in versus timing. So lots of really good content to be covered today. So really hope you enjoy it and get a lot of value out of today's session. And as always, please feel free to add any comments or questions in the notes below, and we'll attempt to answer those throughout the session as well today.
Very good. Looking forward to it.
Thanks for joining us, Peter.
Pleasure. My pleasure to be here.
So I think we're just going to start from the basics, and I just really want to get your thoughts about, so much has happened in the market in the last couple of years, especially in banking and finance and property. There's been a lot of changes. So I just want to really go back to the basics and say, why property investment? Like, is property investment still a good investment strategy? Is it still, a good investment vehicle? And what are your thoughts in relation to that?
Sure. So there's a number of reasons why I think property is probably the best asset class to be invested in. Number one, the banks love it. So if you go to, say, the Westpac Bank to buy Westpac shares, and you ask for 95% of the value of the Westpac shares as security, you're not going to get it.
No, that's right, you're not.
If you go to Westpac to get a loan for a house, especially if you're going to live in it, they probably would lend you 95%. And you have to tick a few other boxes.
And they wouldn't do that unless they were really confident on
That's right.
what's going to happen to the property values in the future.
And the interest rate for getting the home loan would be lower than the interest rate for getting the loan for the shares. So number one, it's secure and the banks know it. Number two, many people from around the world like to invest in Australia because there's security in the title. So unlike many countries around the world, in particular in Asia and Europe where they have leasehold, in Australia we have freehold. So you own your property, that's it. Nobody's going to tell you what to do with it, unless they want to run a freeway through it, but that would be very rare. But in the main, the security of title is also a very big attraction to foreign investors. I could go on for days, but if we look at the flip side, why shares aren't as good as property. There's a lot of fluctuation in the share market.
Property is a more sort of stable, consistent asset class, and I think going back to what you said in relation to the banks wanting to or being willing to lend a higher percentage against the property. I mean, that's sort of got two benefits in my mind. That firstly, like you said, obviously they see it as a secure, low risk asset class. But I think secondly, we can't forget the power of leverage and the fact that being able to borrow that extra amount also means that you're actually able to make more off the money that you have to put in, because you don't have to put in as big a percentage, but the growth is on the entire asset. So
if you went to the bank with $100,000 deposit, and you could probably purchase a home, assuming your income is able to sustain it, of maybe $600,000 or $700,000.
Yeah.
But with that same $100,000, if you wanted to buy shares, you'd be lucky to get $300,000 or $400,000. So already you've been able to buy an asset twice the price.
Yeah.
So even if property performs at half the rate that share does,
you're still in front.
Still okay.
Yeah. So I guess in conclusion,
they need to get a copy of my book, Property versus Shares.
Property versus Shares, get a copy of that book.
Or just Google my name.
We might have to have a link in the comments below as to how people can access that book. So we'll have a link there so that if you're interested in the book, we will get that out to you. So just before we move on to our next question, we've had a question come in from Daniel. Thanks for tuning in, Daniel. So Daniel says, what about if you want to rent it out without living in it? So I'm assuming that Daniel's referring to the percentage that you can borrow, maybe?
Oh, okay.
Maybe that's what you're talking about. Right. So I guess we talked about, a 95% lend for a house that you're going to live in. If you're looking at how much the banks will lend you for an investment property, most of them are going up to a maximum of 90% these days. So it is a little bit lower than owner-occupied, but it's still very good. Now, of course, keep in mind that if you borrow more than 80% of the value of the property, you are going to be paying mortgage insurance. But if it is an investment property, that lender's mortgage insurance is tax deductible and depreciable over a 5-year term.
Can I ask you a question, Marissa?
Yes,
what do you think about lender's mortgage insurance?
Oh, look, I think it has its place. You know, I mean, obviously I try and avoid it where possible, but I think if it's going to be the difference between you getting in the market sooner rather than having to wait multiple years to get in the market, then I think there is justification for it.
Yeah,
and I
think we both agree there, because I see that lender's mortgage insurance is just a cost of doing business.
It is, and you know, by the time you actually take away or add in the tax benefits that you get from the lender's mortgage insurance, because it's quite tax effective for an investment property, you know, by the end of a 5-year period of owning the property, you're pretty much neutral anyway.
Right.
So,
and if you wait 5 years so you avoid lender's mortgage insurance, well, the property prices have gone up.
So yeah, I'm definitely not opposed to paying a bit of lender's mortgage insurance, and I think, you know, just be sensible about it. Make sure that you're being sensible with your debt strategy, and you know, if you've got a good mortgage broker like the people at Rise High, you know, obviously you'll make sure that you're doing it in a really careful and thought through way. So shout out to Twee, Philip, Arturo and Sarah. Thanks for tuning in, guys. Like I said, keep the questions coming. We love having live questions come through. So I'm going to get back to the questions that we had planned. So I wanted to know, in your opinion, what are the most important things that investors must understand and get right to ensure that their investment portfolio is a success? Like if you would say the top 3 things.
Okay. So work out what your goals are.
So important, isn't it?
So if you're looking for long-term capital growth because retirement's a key, then location is very important. At the other extreme, if you're just looking to give up your day job and making money is the most important thing in the short term, then location is not so important. But crunching the numbers is, because if you don't get your numbers perfectly right, if you buy a property for the long term, you know, and you pay, I don't know, $10,000 more than you should have, like in 10 or 20 years' time, that's insignificant.
Yeah.
But if you pay more than you should have and you plan to renovate and sell, or you plan to develop and sell, then time is not going to make up for that mistake.
Yeah.
So goals is number one. Generally, most investors are long-term investors.
Yeah, we definitely promote long-term investing.
So location is critical. And
Yeah.
so far as location is concerned, close to the city and or close to the water. That doesn't matter whether you're in Adelaide, Sydney, Melbourne, Perth, wherever you might be, or even in a country town, close to the centre of the country town is where you want to be. That's where the highest capital growth generally happens.
I mean, on that topic, in a country town, I've sort of always been really low risk investor myself, and always invested metro. And obviously there are some regional towns that are, you know, worth investing in. But do you have some sort of rules around which regional towns you would look at and which ones you would avoid? Like, for example, I've always thought, you know, mining towns are probably not the best option. Do you have thoughts on that you can share with the audience today?
So far as country towns are concerned, you're looking for towns that have more than one reason for existing. So mining towns, generally one reason.
So they're a no go.
Yep.
No go.
No go. So, but if I give a Queensland example, so Townsville, I'm not saying you should go to Townsville because I haven't done the research.
Quite an established regional
Tourism,
area.
mining, defence, university, hospital. You know, if one area is not doing so well, you would hope that the other areas...
There's still other employment opportunities. Yeah. People aren't just living there just for the mining.
So if you're looking at, say...
Newcastle.
Yeah.
So really large regional centres.
Well, even small ones, providing there's more than one reason. Like you don't want to pick a town that only survives on farming, because if they have 2 or 3 years worth of drought, then things are not going to be well in that town at all. But if they have farming, and that's a place where people go to retire, and a place where people go to holiday, and there might be some sub-major employer, well, that's pretty good.
Yeah, okay, cool. So I interrupted you. So you said the first one was know your goals, which I think is really important. The second one was location, which I think we're going to talk more about as the interview progresses today, because you've got some really interesting views on that, and you're always good at picking hot spots. And what's your third sort of tip for really making sure that they have investment success?
Okay, so if there's only one thing that the viewers remember from this, it needs to be this phrase. The value in real estate is in the land.
Yes.
It's not in the building.
I couldn't agree more.
So you need to buy property that has a valuable land component, not necessarily a big land component, because say 200 square metres of land very close to the city is worth say more than 2,000 square metres of land 50 k's from the city. So you need to make sure that the property that you buy, a significant proportion of your money is going towards the land component. And when I say significant, 70%. So if we keep it simple, if you were looking to buy something for 400,000 and you knew that if the house wasn't on it, the land is worth at least 300,000, that's 75%.
Yeah, so I really like that formula because it's a really good guide to help people. So I mean, I guess really if you're looking at properties that have a 70% land value,
land to asset ratio, it's another way we phrase it.
Land to asset ratio, you're really looking at established dwellings.
Yeah.
You know, brand new is not going to get you there.
No.
So you're looking at old, established housing. Obviously, you don't have your depreciation benefits that you do with brand new, but it's more likely to have better growth prospects long term.
The tax benefits are the cream on the cake, but you don't want to forsake the whole cake just so you get a bit of cream.
Yeah.
So the older the better. Ideally, properties built before World War II. And some of the common names we give to those properties around Australia include Federation style, Victorian, Edwardian, villas, bungalows, cottages. But if you can't afford those, anything built like in the 40s or 50s, like double brick homes, post-war homes, because they tend to be generally on good sized blocks of land and they tend to be closer into the city.
Do you like, on the topic of land, do you like sort of looking at blocks that do have a bit of development potential? Because I know you've got a bit of development experience yourself as well, and I know you've done a bit of developing. So, is it a good idea to look at, if you were choosing between a 200 square metre block a bit closer to the city versus a 700 square metre block maybe a couple of k's out that you could actually develop or add some value to, what would your thoughts be in relation to those options if you were tossing between those types of properties?
That's a very good and tricky question, Marissa. Okay.
I like to throw the tricky ones out.
All right, all right, I'm going to give some names of Adelaide suburbs here because that's what you and I are familiar with.
Yeah,
right?
sure.
So you're asking me, would I buy a character home on 200 square metres in Norwood or a 1960s house on 700 square metres in Plympton? I'd buy the house in Norwood.
Would you?
Yeah.
Okay.
Location is the key.
Yeah.
The closer you are to the city, the better off you're going to be.
You'd go for a smaller block, closer to the city, rather than one with development potential.
Yeah, because development potential is only going to be good to me if I want to develop it. And next year there may not be development potential because the council has changed its zoning.
Yeah.
But that villa in Norwood is always going to be a villa. Well, it's always going to be in Norwood. It may not always be a villa because they may knock it down. But it's always going to be in Norwood, and it's always going to be. It's generally going to be a villa.
Yeah, that's so interesting. I think it, obviously everyone has different strategies, and I think that there's probably pros and cons to both.
Yeah.
And definitely I know that within our audience we do have some people that are quite handy and like to have properties that they can add a bit of value to and, spruce up so they can build the rental return and things like that. So I think there's definitely, would you say that, as long as you stick to that 70% formula of land to asset?
It depends on what your goals are. So if mine was just retire wealthy, just buy the place in Norwood.
Yeah.
But if mine was, I want to give up my day job or I want to work part-time, do some of my day job but also do developing, then I'd go for the place at Plympton. But if you're going to buy a development site...
increase your cash flow or...
If you're going to buy a development site, 100% of the value needs to be in the land. Because if you've paid $400,000 for that property, but the land is only worth $300,000, when you get rid of the house, you've just wiped out $100,000.
Yeah.
So it's very hard to buy something with a house on it where the land is 100% land to asset ratio.
Or you have to buy something where you can keep the existing house and subdivide the land.
Yep.
Look,
I've done a number of developments, and developments are good because when you sell them, that generates extra cash flow and you can do some nice things. But if I had my time again and my goal was purely to retire richer, it's just buy those character houses close to the city, sit on them and do nothing.
Awesome. That's great. So that's definitely giving us lots of food for thought. We've got another question from Daniel. Thanks for the question, Daniel. So you were talking about your book, but book-wise, I know a lot of investors recommend Rich Dad Poor Dad. Would you recommend any others? Example, Man Up, The Real Deal, etc. Daniel, obviously, I recommend my own book, The Rise High Investor. Definitely recommend Peter's book. Rich Dad Poor Dad is also a great one. Do you have any other recommendations for Daniel?
So my first book, which was Top Australian Suburbs, which is out of print now, but you could probably get an ebook. But more seriously, authors like Margaret Lomas, so her surname is Lomas. She's got about 10 to a dozen books. She's pretty good. There's one that we use at uni, and his name escapes me, but I will remember before we finish. Another one, if you're interested in development, Ron Forley, Forlee. He's an architect out of Western Australia, and he's written 3 books on property development. And the other one that I almost forgot was Dr. Peter Waxman. He has written an excellent book on investing in Australian residential property.
Beautiful.
So there's a few there that should keep you going.
That should keep you going, Daniel. And we'll put Peter's details in the comments below as well, so you can reach out to him if you want to as well. One of the questions that we get a lot is it a good time to buy? You know, it's always the question, you know, people want to find the right time. Obviously, property cycle, you know, has its flows, and people are always looking for that perfect time to buy. And, you know, it's always a question. So I want to address it with you now, because I know you've done a lot of work in terms of researching, you know, how relevant that is in terms of the actual time that you get into the market. So we're going to talk about timing versus time in the market. You know, which one is more important to ensure success? Is it about when you buy, or is it about how long you hold the property that matters?
Okay. So I might have to use my cheat sheets here.
That's fine, all right. Go for it.
So I always thought that if you could time the market, you knew exactly when it was going to peak and exactly when it was going to be at the bottom, and buy and sell at those times, then you should be laughing.
Yeah.
Which
of course nobody really knows for sure.
No. And assuming you could get it perfectly right.
Yeah. Which would be impossible.
Yeah. But even if you did, you would think that would be fine. But
you would think.
When I looked at the 8 capital cities, so what I did, the research was, I'm going to buy and hold a property in the 8 capital cities for 15 years, or I'm going to try and pick and choose the market so I buy and sell every 5 years. All right. So in the scenario where you bought and held, that we came up with 8 capital cities and 8 different increases in value.
Yep.
If I got it perfectly right, I would have made $350,000 in that 15-year period. Assuming I bought a $400,000 property, I would have made a $350,000 gain, which doesn't sound a lot, but remember, every time you sell, there's commission. Every time you buy, there's stamp duty. And then you're going to pay tax. All of that stuff. But if you did nothing, you would have made more in 4 of the capital cities, and you would have made only a little bit less in the other 4 capital cities. Whereas if you got it perfectly wrong with your buying and selling, you would have lost $150,000.
So there's a lot more risk.
There's a lot. So there's $500,000 difference from trying to pick the time in the market. Whereas if you just sat and did nothing, the difference is only $200, but you're still ahead.
Yeah.
So, providing you can find the right type of property, again, like we said before, the property older the better.
Good characteristics, 70% land
decent
value.
sized land component.
Yep.
Just sit on it.
Yep. So I guess just in summary, your recommendation is not to sort of, you know, buy and sell.
Don't chase the ace.
Don't chase the ace. Don't chase the timing in the market, but buy what you can afford, what your cash flow allows, and hold it for the long term.
So we're going to put this up on course notes, is that right? You can put up Excel spreadsheets?
Absolutely.
I'll email them to you. But just to let you know, over that 15-year period, the 3 top cities were Hobart, Darwin, and Sydney.
Okay, right? That's interesting, isn't it? I wouldn't have expected.
But they were also the 3 worst performing capital cities. So this 5 years was fantastic. They were top of the bunch. The next 5, they will bottom.
Wow.
So again, you've got volatility in those cities. So if you do your research and pick the right property, so I pick the right type of property in the right street, in the right suburb, just sit on it.
Yep. So buy and hold.
And as the equity increases, they can come to you, Marissa, can't they? Release some equity and go buy something else.
Absolutely. And this is like one of the, that's one of the things that I love about property investing, because you can be a lazy investor. Like once you buy your property, you can just sit back and let it do its thing, and let your property manager handle all of the ins and outs of the tenants. So it's a really good, form of investment if you are time poor as well. So yeah.
I think it'll make more sense if people see it on the Facebook page. Is that where it's going?
Yeah, we can put a link up to the calculations that Peter's done.
And they can see all my assumptions, but the bottom line is time in the market
is more important. And I think whilst I completely agree with you, it's always about time in, and that's what we're always telling our clients as well. I think fundamentally it is a really good time to buy right now as well. Yeah. Interest rates are at record lows.
If you've got a long-term vision,
rental returns are good.
It almost doesn't matter when you buy.
It doesn't matter when you buy.
But now money is so cheap.
Yeah.
Most markets have been quiet for a while. So there is demand building up.
Potential.
There is demand building up, and it's only going to take a few things, probably from federal government.
Yeah.
Like the first homeowners assistance,
which they've announced.
Yeah, it comes in on the 1st of January. I'm sure the Prime Minister and the Treasurer are going to get sick of the fact that banks aren't lending, so there'll be probably some directives to say we need to be more realistic. We've gone from one extreme to be able to borrow money just by signing a piece of paper and no docs, to the other extreme where the bank's worried how many coffees I have a day. I mean, that's ridiculous.
Hopefully that will stabilise. But I think you're right, it is a really good time to buy, but it's not really the timing, it's the time in. So the key message there is don't procrastinate. Once you know what your goals are, just get moving with your plans as soon as possible, because the longer you can hold that property before your retirement goals kick in, basically the better off you're going to be. Analysis
paralysis. You don't want that. You don't want to be reading all the books in the world and going to all the seminars and all the conferences and never pulling the trigger.
Yeah, and unfortunately we do see that happen sometimes. People just want to know every single little detail and want it to be perfect, but really it's just about progressing as soon as you can. Shout out to Rue, Sophie, Carl, Jake and Sash. Thanks for tuning in, guys. Really appreciate it. Like I said, put a question or a comment below. So I guess the next thing that I do get asked quite a bit, which I'm keen to get your opinion on, is obviously historically Australian property prices have doubled every 7 to 10 years. And that's been a fairly consistent, average growth that we've seen. Do you believe that's going to continue to happen? Like, what's your views on that?
So property has doubled every 7 to 10 years, probably for the last 40 or 50 years.
Yeah.
But those times are over.
Yeah.
Because that was happening when interest rates were very high. So interest rates were double digit.
Yeah.
Inflation was very high. And on average, over the last 100 years, property has increased at about 2% above the inflation rate.
Yeah.
So another reason why people should consider property is because it's a good hedge against inflation.
Yeah.
But if inflation is at 1.5%, you can't expect property to continue to increase at 7 to 10%, which makes it increase by 7 to 10 years, or double every 7 to 10 years.
Yeah.
So it's taken 15 years nationally for properties to double lately.
Yeah.
So, I mean, Sydney has a big weighting in that national price index.
Yeah.
But on average, it's taken 15 years this last cycle. And I can see that continuing, providing interest rates stay low.
Maybe moving forward, we could be looking at a 15-year term rather than a 7 to 10 years in terms of the doubling effect.
Assuming interest rates stay low, inflation stays low, that's what I can see.
Yeah, I think, I probably tend to agree with you, and I think that, like you said, for property prices to double every 7 to 10 years, you're looking at, compounding 8%.
Yeah, 7 to 10%. So 7.2% per annum gives you a doubling in 10 years' time.
Yeah, so, and that was around the time when the average Australian interest rate was at, between 6 and 8%. So now we're seeing the interest rates obviously down in the 3s and 4s, maybe it's more realistic to expect that the growth will be around that 3 to 4% on average per annum, which would lead us to that 15-year mark. So I think that's spot on. But I think saying that, it's still, when you do the sums, it's still a better investment option than putting your money in any other investment vehicle.
Well, certainly the bank.
Well, certainly not the bank. I mean, you're not making much if you've got your money in cash.
So, the bad news is property won't increase as fast as it used to.
But it's not costing you as much either.
But the flip side is rental yields will improve. Because what's happened over the last 20 to 30 years, property prices have increased at a much faster rates than rents. Yeah. So when I first started investing, basically most properties were positively geared. Because you were getting a rental return around 10%, 12%.
Yeah.
But as property...
That would be nice these days, wouldn't it?
As property prices have risen at a faster rates than rents, most people are negatively geared. But as the rate of property prices to increase slows, and either people choose or aren't able to buy property, so they have to rent, more demand on rental properties.
Yep.
So that'll increase, and what you'll see is there will be better rental yields from properties because rents are increasing at a faster rate than property prices are.
And that will also help with borrowing capacity if we can get rental yields up.
Yep.
So good news all round. So I think it's interesting to see what's going to happen over the next couple of decades. But I mean, I think, like you said, we probably do need to see that time frame might be stretched out. But the reality is that the property prices will still grow.
Yep.
Do you have any doubt in your mind that will continue to happen?
In the long term, in Australia, property prices all over the world go up and down.
Yeah.
Right? So in Australia, the two periods where they dropped for a significant period of time, significant period being 2 years or more, was after the Great Depression and after the GFC. And other than that, yes, they've dropped a little bit, but they've increased by more than they dropped. So in the long term, providing Australia continues to have its obsession with buying the Australian dream, which is a home.
Which is still alive and strong.
Yeah.
Excellent. So I'm also keen to find out from you which capital cities you think present the best investment opportunities currently and over the next couple of years.
Sure. So generally, the property cycle has a very big impact on property prices, and different states and capital cities are at different stages of it. So Perth is still on the way down. Darwin is still on the way down. Sydney and Melbourne had meteoric rises. There's now another little second rise. Hobart had a huge rise. So the other three capital cities have missed out. Adelaide, Brisbane and Canberra, A, B, C. So I think it's their time to shine in the sun. Look, don't expect 15% per annum growth from those cities, because there is not the demand to get that up there. But certainly over the next 5 years, they should do better than the other capital cities.
Yeah.
So far as Brisbane is concerned, I'm just banking my prediction on just the property cycle.
Yeah.
But as I live in Adelaide, not only is it the property cycle, but there are many other good things. We have the largest biomedical precinct in the Southern Hemisphere, centred around the New Royal Adelaide Hospital and SAMRI and Uni of Adelaide Medical Building and UniSA and the Defence Project.
Yep.
Now, I'm pretty sure some of those defence projects are going to go to Western Australia because the Defence Minister is Western Australian, but the bulk of it will be here.
Yeah.
So the people that work in the biomedical industry and the people that work in the defence industry, they earn good money. So they will pay good money either to rent something or to buy something.
So, I mean, I guess flowing on from that, what would be your outlook for Adelaide property values in the next 5 to 10 years? Okay,
so within 10 years, they should have increased by at least 50%.
Yeah.
Within 5 years, all right, if we just do some simple maths, by at least 25%.
Yeah. Great.
I hope so, because most of my portfolio is in Adelaide, so I really hope that's the case.
Most of mine's in Adelaide too, Peter, so let's hope. That's what we're banking on.
Yeah.
So, when you are choosing where to buy, how do you identify your hot suburbs? Because I know you've got some formulas around this.
Yep.
And I really want you to also talk about your gentrification research that you've done around that. Mm-hmm. So, because that obviously falls into this topic of how to select the right location and the right property. So can we talk about that?
Sure. So I look for properties, undervalued properties, close to the CBD and close to the water. So undervalued properties are generally those that have a cheaper median price than the suburb next door.
Yeah.
But it's not just cheaper, like there has to be a reason for it. So for example, if a suburb has a really cheap median house price, but it's full of factories compared to another suburb, then it doesn't mean that suburb's going to do well because it's full of factories.
Yeah.
But if it's gentrifying and the factories are moving out, like they have in Theberton, like they did in Hindmarsh.
Like, would you say like Brompton, Bowden?
Yeah, but not the new part of Bowden.
No.
So my top 5 picks of suburbs in Adelaide.
Mm-hmm. Get your pens out, everyone.
Yeah, added to the 20 that I wrote in the book. Bowden, the old part.
Yeah.
Welland, Richmond, Underdale and Kilkenny.
Yeah.
They would be my 5 picks. They are undergoing transformation. That they are next door to more expensive, highly sought after suburbs. Kilkenny next door to West Croydon, Theberton next door to Mile End, Welland with very close proximity to the city, and North Adelaide. Bowden is. Welland is sandwiched in between West Hindmarsh and Allenby Gardens, both very expensive. And Welland has beautiful character homes on lovely tree-lined streets. So that's what I try and do. So I use what we call qualitative and quantitative analysis. So quantitative just looks at the numbers, median house price, sales. But qualitative is observation. If I go into a really cheap area and I see lots of old cars or burnt out car wrecks in the front yard, and I have to be careful what I say because I don't want to offend anyone that's watching. But if I see a not so nice area, right, compared to another suburb which might have a similar house price, but I can see the little black BMWs and Audis, I go into the cafe and it's not just, sir, would you like skim milk or full cream milk with your coffee? Do you want coconut milk? Do you want soy milk? Do you want almond milk? Is there a...
I reckon that's the way to tell you.
Yeah. Is there a...
So make sure the cafe has almond milk.
And quinoa and kale. Got to have that. If it doesn't have that...
What about avocado?
That's a bit old school now.
Is that?
Even I eat avocado now. Before it used to be all the millennials.
Because it was the avo on toast that was stopping people from buying their houses.
But it's the new kale. I don't know whoever said you could eat kale. Kale is a weed. It should be... You should be... putting it on a list to kill it. I don't know how people can eat it.
So the concept of gentrification is basically looking for areas that do have beauty.
Character homes. So
homes.
Gentrification will generally occur in areas where there's a high proportion of character homes. And again, they have to be close to the city or the sea. So examples in...
So when you say close, like how many kilometres
it depends on which city you're in. So in Sydney, areas that have already gentrified include places like Balmain and Paddington. In Melbourne, it's Richmond and St Kilda. In Brisbane, it was West End. And in Adelaide, places like Norwood, Unley, St Peters, Henley Beach, Semaphore.
So would you say that those suburbs that you've just listed, it's too late to get into those suburbs?
So you have to look at the next
crop.
So
you've got to look at the next
in
suburb
Sydney,
over.
I would be looking at St Peters and Tempe. In Melbourne, Flemington, Yarraville and Seddon have already probably taken off, but Footscray and West Footscray. And Adelaide, I've already mentioned.
Yeah, okay. So, that's a really good... You've given us some really good tips today and some really good guide on where to look and what to look for, and that you're just a wealth of knowledge. Thank you so much for sharing all of that.
My pleasure.
We do have another question that's come through, just waiting for that to come through. So, outside of that, we've talked about your hotspot predictions, we've talked about the gentrification. We might also, you've done a bit of research on gentrification. Are you happy for us to post some of that?
Yeah, look,
in the comments below so that people can read a bit more about it?
Yeah, so you can probably find a copy of my paper online.
Yeah.
Or maybe we just get the executive summary and we copy and paste that. But I'm really interested in gentrification because I grew up with it. I grew up in Torrensville at a time when nobody wanted to live in Torrensville except for newly arrived Greeks and Italians.
Yeah.
But now it's a very different place.
Now it's a popular suburb.
Now we have cafes that serve
Kale.
quinoa and kale.
And that's obviously made all the difference. So we've had another question from Daniel. Thanks, Daniel. So it says, now when you say buy and hold, are you including renting the property out in that time as well as the utility costs, etc. included? So I think, definitely with the buy and hold strategy, you are actually buying the property and then renting it out for the long term. And obviously, as a property owner, a property investor, you do have other costs. You've got the costs of, your council rates and your utilities, like the water rates, and water rates can be reimbursed. But you do have certain costs associated with owning the property that you need to factor into your cash flow and make sure that you can continue to afford the property. I think that's where the question was going.
If we pick that $400,000 property and it goes up by, and let's say it earns $400 a week, all right? So if it goes up by 5%, it's increased $20,000 in value.
Yeah.
But the reality is, it's probably going to cost you $100 a week to keep.
Yeah.
So it cost you $5,000, but it's gone up by $20,000.
Yeah.
But you fast track 10 years.
Yeah.
The rent's no longer $400 a week.
It's
the
gone
rent's
up.
$700 a week.
Yeah.
And if your interest rate has stayed about the same, so was your mortgage repayment.
Yeah.
So now, not only is your property going up in value, but there is money left in your pocket after you've paid all your expenses.
Yeah.
The first few years are your hardest
Yeah.
when you're investing in property. And it's
Gets
the first
easier with
property that's
time.
the hardest, because the reality is you have to save money for that. But if you've bought the right first property...
Or you have to have equity in your home.
Yeah. But if you've bought the right first property, you can use equity in that one property to buy the second one.
Yeah.
If you've bought a good second property, you can use the equity in the first and the second property to buy the third one. The hard one is the first one.
Yeah.
Getting your foot on the real estate ladder.
And the more you
is the
have,
hardest
the
one.
easier it is to build.
Yeah.
And I think, we always really try and reinforce the importance of cash flow and understanding your cash flow. So I think the only people that lose as property investors are people that buy properties they can't afford to keep, and they are forced to sell them before they experience the increase in value. So I think, Daniel, like the main thing is to really understand your personal cash flow, understand how much each week you can actually commit to your investment portfolio, so that if it's $50 a week or $100 a week or $200 a week, at least you know what you can comfortably put towards your property investments, so that you're not putting yourself in a position that's going to cause you financial stress or hardship, or that's going to have to make you have sacrifices in your life. We've actually got a good cash out-of-pocket calculator for an investment property that you can access from the Rise High Investor website. So we might put the link to that in the comments below as well, so that if you want to just check out the calculations before you buy a property, just to know how much that property will cost you out of pocket, it will give you a good guide for roughly what it will cost you, and you have to make sure you can afford that before you buy it.
Yeah, so I agree 100%. You need to be very careful, and the bank's going to have a big say in what you can afford anyway, can't they?
Well,
you might think you can afford $100 a week, but the bank says, we don't think so.
Yeah, and I think the other thing as well is that it is going to be, the banks are putting more criteria on lending, especially for investors following the Royal Commission. So higher yields are probably going to be more important for investors that are wanting to aggressively build their portfolios. So that could also influence what you buy and influence the cash out of pocket. But yeah, it's really important to understand all your costs, with eyes wide open before you go in. Because once you've bought it, you don't want to be having to sell that property without you being able to make the decision if or when to sell. And
the other mistake I've seen beginning investors make is they sell that investment property because they got a tenant from hell.
Yeah.
Your tenant, you can move out the tenant from hell sooner or later, but if you've got a quality asset, you just have to bite the bullet, go through the hard times, get rid of them, update the property so it's a decent property that attracts a decent tenant, and then move on.
Make sure you've got good property insurance, including landlord insurance, and a good property manager, so that you protect yourself in those situations. Look, I think we've run out of time today, but Peter, thank you.
Pleasure. Thank you, Marissa.
Today has been great. Lots of really good tips that you've shared with our audience. Really appreciate your time. Like I said, we'll put a few things in the comments below. Thanks for tuning in again today, and we'll see you next time on Rise High TV. Thanks and have a great day. Bye.